Gold returned 52% in the last 12 months. The companies that mine gold returned 110%. That's double the metal itself. If you're buying gold to ride this rally, you might be buying the wrong asset. Here's why GDX is the smarter trade. GDX is the VanEck Gold Miners ETF. It doesn't hold any physical gold. Instead, it holds the world's largest gold mining companies: Newmont, Barrick, Agnico Eagle, and 55 others, all in one ticker. Expense ratio is 0.51%. Total assets, $29 billion. It's the largest gold mining ETF on Earth, and the most liquid way to get exposure to the entire industry without picking individual stocks. But here's what makes GDX different from owning physical gold or buying GLD. GDX gives you operational leverage on the gold price. When gold goes up, miners don't just go up the same amount. They go up 2 to 3 times more. And in this rally, that's exactly what happened. Over the past 12 months, GLD, the physical gold ETF, returned about 52%. GDX returned 109.6%. The Junior Miners ETF, GDXJ, returned 120%. Same gold rally, wildly different results. The math is simple but underappreciated. Gold mining companies have mostly fixed costs. The all-in sustaining cost to dig an ounce of gold out of the ground is roughly $1,200 to $1,400. That cost barely changes whether gold is at $2,000 or $4,000 or $6,000. When gold trades at $2,000, a miner earns about $600 to $800 per ounce in margin. When gold climbs to $3,000, that margin nearly doubles, even though gold itself only moved 50%. Every additional dollar in the gold price flows almost entirely to the bottom line. That's operational leverage, and it's why miners outperform gold on the way up. Earnings explode, free cash flow explodes, dividends increase, share buybacks accelerate. The whole industry re-rates. Now the part you need to hear. Operational leverage works in both directions. When gold corrects, miners get crushed. In 2022, gold dropped about 10%. GDX dropped 35%. That same 2 to 3 times amplification that creates outsized gains creates outsized losses. Gold miners also carry company-specific risks that physical gold doesn't have: mine accidents, permit delays, strikes, political instability in producing countries, cost inflation, management decisions. When a mine in South Africa floods, or a Mexican operation gets nationalized, GDX feels it. Physical gold doesn't. And in an environment where gold trades sideways for months, miners often underperform. They need a directional move to trigger the leverage. Flat gold means flat miners with extra volatility on top. So what's the chaos capital take? If you're bullish on gold long-term, and the data we covered in our gold video says you should be, GDX gives you amplified exposure for a fraction of the capital required to buy physical bullion. $100 in GDX gives you the impact of $200 to $300 in physical gold. If you want pure safety, physical gold or GLD is the right call. No company risk, no operational risk, just the metal. If you want amplified upside and you're willing to accept amplified downside, GDX is the smart trade. And if you want maximum leverage with maximum risk, GDXJ gives you the junior miners. The smartest portfolios often hold both, physical gold or GLD as the foundation, GDX as the leveraged kicker. You get safety and you get acceleration. The miners give you the gas pedal. The bullion gives you the seatbelt. Owning gold is owning insurance. Owning gold miners is owning the entire industry that turns insurance into profit. One protects you, the other compounds for you. That's the difference. The capital markets are chaos. Embrace it, and I'll see you in the next video.